Welcome to RenMac Off Script. We open to discuss markets, economics, policy, history, and life. It's the 20th of September, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. Actually, 80% of the charts that we reference are posted to our Twitter account. The others are for our clients. You can see us on YouTube. And if you tell a friend, tell them to listen to the pod. That's what my wife calls it now, the pod. So obviously, Neil, there's a big week here. Kudos to you. 50 basis points from the Fed. That gap between tens and twos has closed, but it still remains pretty healthy. What do you see from here? Obviously, you think the Fed did the right thing, and tell us a little bit why, and then what you think the trajectory is from what you heard from Powell. And does it change anything in your world?
Yeah, sure. I mean, I do think the Fed did the right thing. I think by going 50 in September, they've basically, for the time being, clipped the, I guess you could say, the left tail risk scenario to growth, right? So the fact that they're kind of trying to get on sides here mitigates the downside to the economy. In market parlance, you could basically say that they're raising the strike price on the put. Like, what is it going to take for them to step in? So I think the other, big takeaway for me is that Powell is in control, right? I mean, I think he is the person who wanted it. He's the one that has to go up there and face the firing squad of the financial press. And I think he understood that going 25 would have probably been a huge mess to communicate. I thought it was interesting that he basically said the time to act is actually when the labor market is strong. He made that point. And I think that was an interesting kind of way of framing it. But really, this is about reinforcing the gains that we've already made in the economy and not letting it slip away, more so than trying to react to something after the economy's already fallen off of a cliff. That's not what's going on. And I thought he was pretty good about trying to cage it in those terms. Now, so I thought the move was good. Had they gone 25, I would probably sound a lot more cautious than I am at the moment. So there's that.
So let me ask you this: what's the probability in your mind of hard landing versus soft landing now?
I think the odds of a soft landing have gone up.
Right, but are they 80%? Are they 60%? Where are you in that?
I mean, I don't know, like 75%.
Yeah.
I mean,
okay.
I think that obviously, I mean, you remember that we always have our sort of, just like you have your market clock, we have our sort of quadrants, right? Inflationary boom, stagflation, soft landing, recession. In my mind, there are no odds at this point of an inflationary boom-like dynamic, and there are no odds really. The odds of both of a stagflation and inflationary boom are zero. So really, you're jockeying between these two outcomes. And right. So I think the distribution of what's possible, I think, has narrowed. And, look, I don't think we're out of the woods, but I also don't think it's a big deal either. I mean, look, at the end of the day, if you get like a clunker on jobs, Powell just come back in and go 50 again, and that'll be it. I mean, so, I think what's important is he wants the soft landing. He wants to stick the landing. He wants to make sure that labor markets are okay. And one of the things you saw in the statement was the insertion of committed to maximum sustainable employment. That wasn't in there before. So I think that's a tell. And as I said, I think he's in charge of the committee. The next phase of this, the first battle was 50 or 25. He got his 50. The next stage is going to be how quickly does it make sense to accelerate the path to neutral. The Fed doesn't know what neutral is. They think it's higher than it was before. Powell was non-committal. I mean, he basically said you shouldn't assume that 50 is the new cadence of rate cuts in terms of each meeting. But, at the same time, they're obviously contingent on what happens with the data. And I do think that there's probably this pipeline of data weakness that's in front of us. I don't think it's going to be a big deal. But, I mean, what are the odds that you get a weak jobs number, maybe GDP data catches down? I think that probably supports another 50 basis point move. So I'm kind of at 50, 50, and then 25. But, I mean, that's a little bit out of consensus, I guess. I mean, the markets right now are, they saw 50 basis, barely 50 basis points in September, but 25 and 50 for the next two meetings. So maybe there's a little bit of politics going on with that call. I mean, I'm not really sure. I don't think that sort of argument makes much sense, but I've heard some clients say it to me because I mean the markets are priced for less in November and more in December by my last look. But no, I mean, this was as good as you could have expected it to go. I think it was the right thing. And if they did the right thing and you think they're willing to do the right thing again, of course you have to say that the recession odds have come down.
Right. Well, the question is were they too late, right? And have they moved enough? And if you look at that Fed fund versus 2 year, you're still 100 basis points wide, which says there's probably more of that gap to close. And the longer that gap is wide, the more risk there is to the downside, right? But it's a great point that they can go another 50 and kind of have that optionality. My question is when's the next meeting? Where is it in relationship to the election? And we're going to hit Steve here quick on what the politics of all this is and what the market's inference is. But is it before or after the election?
It's after. The next
Okay.
meeting is after. But as I've argued to our
Phew.
client, it's on November 7th. That's the next meeting. We get 2 employment reports between now and then. So the next one comes October 4th. And then we get one, I believe right before the next jobs number. I have to double check that. But at any rate, the next Fed meeting is on November 7th. And, I've argued to our clients that I actually think it's easier for the Fed to do another big move at that time because they're going to be on page like, I don't know, C1 of the Wall Street Journal as opposed to A1 because it's sort of, the outcome of the election is still in doubt. And oh, by the way, in other news, the Federal Reserve cut 50 basis points again. So it's kind of, it's one of these things where the path dependency story kind of falls apart once they actually moved, right? I mean, several weeks ago, I was getting the question, well, if they don't go in July, they can't go in September because of the election, and they can't go in November because of that. So the earliest they could go is December. I mean, there was a lot of people putting a lot of sort of stock in arguments like that. And I think that those arguments have really collapsed now.
So. Yeah, for sure. Well, the market reaction was bullish. That's not unusual. The market, we'll get a bump from that. What's unusual is having the data turn because the Fed cut rates and the market doing substantially better, particularly cyclicality after you get that Fed rate cut. And that's why I ask if you think the data gets better or worse as we go, because traditionally the trajectory of data is weaker for the next roughly 3 months. The market sees through that and turns usually a month or two into it. So
look, I mean, I do think that, like I said, I think that there's probably a pipeline of weakness, right? Like hiring rates are still weak, right? It's not automatic. So I mean, there's going to be a little bit in terms of weaker data, and that will probably fuel some additional bets that the Fed maybe still is restrictive, right? And on top of that, I think the next important debate is going to be inflation. I mean, we don't know yet how the Fed is going to respond if inflation remains persistently below 2, right? I mean, at the end of the day, over the last 4 months, core PCE inflation has been below 2% each of those in each and every month. It's been below 2% sequentially most of the time since last summer. If you continue to see that go on, how does the Fed think about what they need to do in terms of getting to neutral? Do they think they can speed it up a little bit because inflation is still below 2? That means they're still tight. Do they think, we can just string out a bunch of 25s from here on out, right? Maybe the reaction function is if you have weak activity and weak inflation, you go 50. If you have weak activity, maybe you go 50. And if you have steady activity and sort of weak inflation, you can go 25. I mean, maybe, it's hard to know. But I think we'll get to, look, I think to me, it's sort of, think about the big picture here. The big picture is Powell wants a soft landing and he wants to support the labor market. That's fundamentally a favorable outcome, I think, for the economy and for market participants. And it also demonstrates that inflation is, kind of been quelled. I mean, at the end of the day, to me, it's like, keep it very simple, right? We're talking about the stock market is up. I mean, you can tell me how much it's up over the last 6 months. Retail gasoline prices are down over the last 6 months. And the Fed has cut and is likely to continue cutting for the next, let's say few months.
Yep.
How is that bad?
Yeah, no, exactly, exactly. S&P made a new high. How's that bad? Is one thing I always ask clients. I think one thing that from a market's perspective that we'll know when the Fed stuck the landing, right, is when discretionary starts to break out versus particularly staples versus the defensive. Discretionary is historically a very good tell on kind of the contrarian side of the ledger of what's happening to the consumer and ultimately what's happening to the economy. So, Steve, let me ask you: 50 basis points, a big move right out of the gate, even though it was warranted in our view. I'm sure some in your neck of the woods are looking at it as a political process. What are you hearing? How do you feel about that? And, frankly, at this point, it's so close to the election. Is it really going to help other than maybe in the 401k, as people say it?
Well, I'm feeling about it, just not surprised. I mean, we're in the political season. You expect politicians to politic. If you look back, as far as I can see, in 2008 and 92, I believe you had the Fed cut interest rates in September. It didn't benefit the Republican incumbents in the White House at the time, as Democrats went on to win both elections. I don't think it's partisan. I think it's sort of, to your point, questions, will this perceived benefit really materialize to voters before November? And based on that historical evidence, maybe not. You get into the long and variable lags. Maybe it's too long, too variable, again, to have that election boost. But, as Neil was saying, it is a powerful talking point for Democrats. I mean, it definitely doesn't hurt Harris. Harris has had, by objective standards, probably two, well, from the Harris point of view, she's had two basically months of things where nothing has gone wrong. And Trump, on contrast, you could argue, maybe has 2 months where nothing's really gone right. But you get into where we are right now, and the polls show the race is still very close in those battlegrounds, swing states. So you look at the reaction to the 50 basis point cut. Trump, not surprisingly, basically said, well, they only cut an emergency. Maybe the economy's bad, and definitely political, something he's accused Powell of doing before. That's not surprising. I don't think you would expect him to respond any other way. You look at how Joe Biden responded by sort of having a mission accomplished speech at the Economic Club of Washington, sort of, thinking more, I think, at this point about his legacy. There've been all these attempts of the purported benefits of Bidenomics that really never registered with voters. I think he's really focused on securing his legacy, so he's not really remembered as more of a Jimmy Carter type. And that is in contrast with what Kamala Harris was saying, sort of saying it's welcome relief for voters, but more needs to be done. And I think if Biden tries to go out and continue this campaign of trying to convince voters that, hey, the economy is better than you think, and over the last 4 years, just sort of ignore all the compounding effects of inflation, give me credit, that's going to put Harris in a difficult position. So I thought it was interesting to see how she sort of made that contrast. But look, we've had a lot of polling come out recently. Most of it sort of, I think, reflects this post-debate bump for Harris. We've seen, because so much of the polling, some varying results, but I think generally speaking, her approval rating has gone up more at the national level than a lot of the battleground states. And the New York Times poll actually found the opposite. But if you sort of look at the other polls and collective, that's the case. But we talk about the states that matter. In Georgia, Trump's actually performing better now. I think that has probably something to do with him making up with the popular governor there. In North Carolina, it's going the other way. And that's probably why I think you see Harris maybe focusing more on that opportunity. And that's because the Republican gubernatorial candidate down there has a lot of issues. You can just look up what those issues may be if you're interested. But that's not helping. And I think, the fact that Harris is focusing more on North Carolina than Georgia suggests that she's not comfortable or confident in where her campaign's going in Georgia, which leads us to Pennsylvania. And I'm biased because I was born there. But again, I think objectively, that's the Keystone State will be live up to its name here in deciding the election. And that's still a very close contest. So look, despite 2 months of everything going right for Harris, everything going wrong for Trump, from that standpoint, it really hasn't moved the needle that much there.
So let me ask you, and maybe you don't know this, so it's not a fair question just throw at you, but you might know it. Where have the candidates focused their time, right? And where is that different than maybe they were focused, say, a month ago or 6 weeks ago, right? Has Trump given up on, say, Wisconsin? Has Harris given up on, say, Georgia? Is there any kind of shift in their scheduling that would say that they're, that they've kind of given up on one and are focusing instead on the other?
Well, I think for Harris, he's definitely spending more time in North Carolina than Georgia, at least when going back to a few months ago. Both candidates are focusing a significant portion of their time in Pennsylvania, more than others. I know there was a lot of attention paid to Trump going to New York this past week. That's not any attempt that he's going to win New York. That's really to try to help the down ballot House Republicans, because look, the House is going to be decided in New York and California, and obviously those states are prone to go heavily for Harris. They're not competitive at all, but they're gerrymandered districts, and so that's where Trump's sort of trying to think ahead, as if he does win, Democrats might have a slight edge in the House. Can he sort of try to ensure that he'll have a Republican sweep? Because we talked before about how Republicans are favored at this point to win the Senate. You have Democrat John Tester trailing his Republican opponent there by 5 points. So polls suggest that state's going to flip. You already have West Virginia flipping, so that would give Republicans a bare majority of 51.
What's up with Ted Cruz?
Closer than he probably would like.
I mean, I heard that the Trump campaign team was basically calling him out, like saying like, what the hell is going on in Texas? I've seen some polls that show his challenger, Colin Allred, like leading by a couple points.
The polls are definitely closer than they should be. I think that is a state where you're hoping, if you're the Republicans, that just this trend we've seen of a decline in ticket splitting, that Trump will perform high enough to carry Cruz across. But you raise a interesting point, is, where are campaigns sort of forced to devote resources? And Republicans would prefer to be focusing more on offense, given that they have a very advantageous map this year, just because the competitive seats tend to be all clustered in Democrat areas, rather than playing defense, trying to support an incumbent like Senator Cruz in a state that should not be competitive. So that's, I think, significant.
As a public service announcement, I want to, what is the name of the North Carolina governor, so people can Google whatever illicit business he seems to find himself in?
I think it's Mark Robinson.
I think it was Mark Robinson. That's right.
All right.
Just wanted to make sure.
I need something to do this afternoon, so
no doubt you could probably dig up, some video evidence that like Trump people actually put him over the line in the primary. No, I mean,
Ashley Madison accounts, adult websites, and take your pick from there. I'll just
got it.
Want to give him a little teaser.
The Bayesian tree goes from there. Understood. Well, look, I think one of the things that that we're focused on from the equity markets, right, is this history of cyclicality after the Fed rate cut, and that's why I think this data is going to be so important. If we look at that data historically, forget the markets, but what the market's interpretation of the data is, we would definitely think or believe that this data is going to be softer as we go forward. I thought, interestingly enough, this week we did get semis to break on our relative work. So we had technology break a couple of weeks ago overall in the Russell 1000 equal weight. We now had semiconductors and semi-equipment break. So that puts them in a more defensive position, obviously. But at the same time, keep in mind, staples made a new relative strength low, right? So it is not as if this money is flowing in mass towards the defensives. Certainly some pockets, you get REITs, you're getting some areas of healthcare that are seeing it. Clearly, utilities are benefiting from this. So it is really under the surface that is driving this. As we made a new high for the S&P, the 20-day highs did not accelerate to a level above anything most recently. I think I'm going to throw the number out here. I don't know if it's exact, something in the high 20s. So it's, what we look for is kind of affirmation that we're starting a new leg of a bull market, is another expansion in 20-day highs, and we're not getting that. That's not bearish, but it usually means that you're not in a momentum market, you're in a trend market. And when you're in a trend market, it is 2 steps forward, 1 step back, 3 steps forward, 2 or 1 step back. So you get these opportunities to buy oversold conditions, and that's how we are, in fact, thinking of it. Keep in mind that we still have the seasonal weakness that runs through the remainder of this month and into most of October. About 2 weeks before the election is the seasonal point at which markets bottom. They don't tend to bottom after the election. They don't tend to wait for whomever becomes president. The markets figured out before then, so you might be able to have a bit of a tell in terms of the sectors and the industry groups that are working, call it late October, as to what exactly is, or should say, who exactly might be winning the race. Neil, what's on the docket next week?
Well, we have a couple of things I'll be keeping an eye on. The first will be consumer confidence. That comes out on Tuesday. It's a September data point. This is from the Conference Board. We're paying attention to that because it includes information on how people feel about the labor market. And, generally speaking, people feel a little bit worse about the jobs market. And the conference board data tends to be sensitive to labor market conditions. Some measures of consumer confidence that we look at, sort of higher frequency data, have been improving, which isn't a surprise because gas prices are down and stock prices are up. Now, we also get durable goods. Capital spending intentions, generally speaking, have been sluggish over the last, several months. So you'd expect to see, core capital goods orders remain weak. We have seen this sort of divergence between core shipments, but we're importing a lot of capital goods. Maybe that's, for the, chips and IRA stuff and semiconductor plants. So you do see this kind of disconnect between core durable goods shipments and imports of capital goods. So we'll be looking at that as well. And we will get revisions. People care a lot about jobs revisions. We'll get revisions to the national accounts data, annual revisions to that.
Do you think they're revised down?
We'll see. I don't have a strong opinion on it.
Yeah, fair. Steve, I know we have a spending decision. What's going on there? Will we have a shutdown? How do you think about that?
So far, more motion than progress. House Republicans failed to advance their version of a spending bill, which really wasn't a surprise. So I think everything's sort of pivoting now towards what's cooking in the Senate, which is probably a continuing resolution till the middle of December, relatively clean. The government funding does actually run out the following Monday, September 30th, but Congress right now is scheduled to adjourn Friday. There's a lot of bipartisan interest in not shutting down the government just because you really want to have the political blame and also getting home to campaign to keep your job. So I still think the odds of shutdown are pretty low, despite us sort of coming up against the clock here. And then the thing to watch after that is going to be, when lawmakers return. Obviously, in that you're going to have Republican leadership elections. In the Senate, Mitch McConnell is going to be replaced. He already said he's stepping down as leader. And then in the House, it's going to depend on whether House Republicans have a majority. And if not, I think you're definitely going to see a challenge there to Mike Johnson's position. And that's where how he handles this sort of stopgap situation, I think, is going to be really important. So that's sort of what I'm keeping an eye on.
Yeah, great. So we'll be watching, obviously, less the market level. We're in a trend. We're in an uptrend. We broke out. All those things, suggest the market's still in a bull market. It'll be those characteristics. Do we start to shift back towards beta? Do we start to shift back towards cyclicality? These will all be signs, particularly consumer discretionary. These will all be signs that, yes, in fact, we are sticking that landing and are on a better trajectory as we go forward. The other thing I would watch is, does the 2-year continue to decline in terms of yields? If that's the case, it is the market rate telling you, or telling the Fed, telling all of us that, yes, in fact, there is more stimulus needed, and that neutral rate is lower than where the Fed is now, which will require, obviously, a little bit more aggressive action for them to get it right. Join us again next week. We'll be 1 week colder, 1 week wiser. Don't forget to follow us on Twitter and YouTube. And if you want deeper insights, you can go to RenMacAccess.com, where we post and keep people up to date from the retail side of the ledger. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Allen.
We'll see you.